looking at chapter 18 of the text, which develops the concepts and vocabulary associated with studying macroeconomics in an open setting. We started off talking about nominal exchange rate, nominal depreciation, real exchange rate, real appreciation, and real depreciation. We now want to look at the uncovered interest parity condition, or what we call the interest parity condition for short. Now, this is an arbitrage condition which says that the expected return in terms of domestic currency or domestic and foreign bonds must be equal. Because remember, now we said that you don't, like in chapter 4 of the text, we assume there's just one type of bond with one interest rate when you're looking at a closed economy. But now you have two bonds, domestic bonds and foreign bonds. So you have two interest rates. One is interest rate that you can earn on domestic bonds, and one is interest rate that you can earn on foreign bonds. The UIP condition, either uncovered interest parity condition, says that the expected return in terms of domestic currency or domestic and foreign bonds must be equal. Now, since it's an arbitrage condition, so we're going to derive it using the arbitrage condition that arises from trading domestic versus foreign assets. Here we're talking about domestic versus foreign bond. So let's assume we have two economies, US and UK, and we want to consider a one-year investment from the US investor's perspective, right? So here we're going to consider from the US investor's perspective, US is going to be the domestic country and UK is going to be the foreign country. Now, he wants to do a one-year investment. Now he has two options. He can invest in one-year US bonds, which will be a domestic investment for a US investor, or he could invest in one-year UK bonds, which will be a foreign investment for the US investor. So let's look at some notation before we actually look at how do we find his expected return from each of his investment options. So we're going to let IT be the one-year US nominal interest rate, which we know for the US investor is the domestic interest rate. I star T is the one-year UK nominal interest rate, which we know for the US investor is the foreign interest rate. ET is the current nominal exchange rate between dollar and pounds. And we know the text uses the indirect definition of the nominal exchange rate, which means that it's going to be defined in terms of units of foreign currency, i.e. pounds, from the perspective of the US investor, per unit of domestic currency, i.e. dollar, from the perspective of the US investor, right? So the nominal exchange rate, based on the indirect definition from the perspective of the US investor, is price of $1 in terms of pounds, or how many pounds is $1 worth. So this is ET is the current nominal exchange rate because we're going to be looking at year T, right? This is the one, this is the interest rate, and then this is the domestic interest rate, foreign interest rate, and then this is the current nominal exchange rate. Now, EET plus 1 is the nominal exchange rate expected at time T for period T plus 1. So this E means that it is the expected nominal exchange rate, and this T plus 1 means this is the nominal exchange rate that you expect at time T for period T plus 1. Now, at year T, if we're standing, we don't know what the exchange rate will be next year in year T plus 1. So the best that we can use is the expected exchange rate, and hence the E superscript here. So let's actually look at, like we said, we want to look at a one-year investment from the US investor's perspective. So one option is to invest in one-year US bonds, which we like said for a US investor is a domestic investment. So now if he invests $1 in a US bond, then he's going to get next year the dollar back plus the interest he earns on the dollar invested in the US bond. So he's going to get the dollar back plus the interest on that dollar, which is IT times 1. Because remember, IT is the US nominal interest rate. So you're going to get your dollar back plus the interest on the dollar, IT times 1. So we can say that if you invest $1 in US bond, then you're going to get 1 plus IT dollars back, because this is the $1 you get back plus the interest on the dollar. And alternatively, he could decide to invest the dollar in UK bonds. But if you want to invest in UK bonds, first you need to convert dollars to pounds based on the current exchange rate ET. Right? And you know the exchange rate ET tells us the number of pounds per dollar, because based on the indirect definition of the exchange rate, it's the number of pounds per dollar. So this means that $1, when I convert it into pounds, gives me 80 pounds. So the first step to invest in UK is to convert dollars to pounds based on the current exchange rate ET. Now we know that for every pound invested in UK bonds, you get a return of 1 plus I star T pounds, where I star T we know is the foreign interest rate, right? So you get the pound back plus you get the interest on the pound, which is I star T times 1. So for every pound invested in UK bonds, you get 1 plus I star T pounds next year at year T plus 1. So if I invest 80 pounds in UK bond, so I'm going to get 80 times 1 plus I star T pounds, right? So you first converted your dollar to pounds based on the current exchange rate. And then we know for every pound invested in UK bonds, you get a return of 1 plus I star T pounds. So 80 pounds invested gives you 80 1 plus I star T pounds. And now, eventually, at the end of the investment period, you need to convert back to your home currency, dollars in this case. But since, actually, we're looking at what the expected return is, right? at EAT, when you're analyzing this, when you're making this decision whether you should invest in US or UK bonds, right? You're deciding whether you should, and you know, okay, if you invest in US bonds, you're going to get 1 plus IT dollars expected return next year. But obviously at EAT, you do not know what the exchange rate at T plus 1 is, because it's at EAT that you're considering this decision between investing in US or UK bonds for 1 year. So standing at EAT, you don't know what the exchange rate next year is going to be. So you have to use the expected exchange rate, like we said. Right, so now we know, because we're using the indirect definition of the nominal exchange rate. So we know ET plus 1 is giving us the number of pounds per dollar. So if I take the reciprocal of this, 1 by ET plus 1, it's the number of dollars per pound. So I know that 1 pound is worth 1 by ET plus $1. And how many pounds do I have from investing in the UK bond? We have ET 1 plus I star T pounds. So if I convert this to dollars, how many dollars will we have? We will have ET 1 plus I star T divided by ET plus $1, right? So you started off with $1, you want to invest it in the foreign bond, you need to first convert it into pounds, right, at the current exchange rate. And then we know, okay, you'll invest it in the UK bond, and after a year, once your investment is over, you need to convert it back into the home currency based on the expected exchange rate. Because when you're considering this decision at EAT, you do not know what the exchange rate at EAT plus 1 is going to be. So the best you can do is use the expected exchange rate. So this tells us that for every dollar invested in the US bond, from the perspective of the US investor, he'll get 1 plus IT dollars next year. If instead he had invested a dollar in the UK bond, this is how many dollars he would get. Right, so putting it together, so for every dollar the US investor expects, this is the expected return for 1 year investment in the US, the dollar plus the interest to earn. And this is the expected return from 1 year investment in the UK instead. And we know the ET here comes from the fact that when you want to invest in the foreign bond, you need to convert domestic currency to foreign currency. And this ET plus 1 comes from the fact that once the investment period is over, you need to convert back into home currency. And because you're comparing these expected returns at EAT to decide which bond should you invest in. So at EAT, you do not know what the exchange rate at T plus 1 is going to be. So the best you can do is use expected exchange rate. So now we're going to make an assumption that in making the portfolio choices, financial investors only care about expected return and they ignore differences in risk. So because of arbitrage, the following relation must hold. That the expected return in terms of domestic currency from holding domestic bonds given by the left-hand side is equal to the expected return also in terms of domestic currency from holding foreign bonds. So this is the interest parity condition in exact form. Like we said, this is the expected return for $1 invested in US bonds in dollars, and this is the expected return from $1 invested in foreign bond also in dollars. And because of arbitrage, they have to be equal.